Hello and welcome to video lecture on call and put option. What is call and put option? It is a derivative instrument. The options are of three types: index call and put option, stock call and put option, currency call and put option. This is the spot price of 5th November at 3:30. Market has closed at 12,120. Nifty option chain. This is a option chain available in front of you. If you see in the middle, there is a strike price at which the betting take place, and the call option is on the left side and put option is on the right side. If you look at the LTP is the premium which the call buyer and the call seller will call buyer will pay to the call seller. So this is the premium at different strike prices. And the pink color is the in the money call. And if you see here, 12150 till 12750, these all are in the money put option, and the white portion of put is out of the money. White portion of call is out of the money, and 12150 is at the money in the put option, and 12100 is the at the money call option. So these two are ATM, at the money, because it is currently related to similar to 1 to 1 12,120. So this is nearby to this price, so it is at the money. 12,100 and 12150 both are ATM, at the money. Now in equity derivatives, in option chain, mostly the volume in the Bank Nifty and Nifty is highest. See the turnover and see the volume. Mostly you will find Bank Nifty is a most volatile stock because of RBI's monetary policy. Every 2 months there will be participants in the market. They will be eagerly waiting for the Bank Nifty to change. So market participants, they change the strike price, they change the volume of the market, and the option premium also shoot up. If the Bank Nifty is having a good volatility, the option premium will also change. So option premium is dependent upon the um, volatility of that banking stocks. So there are total 12 stocks of bank which are included in the Bank Nifty. So this index is of 12 banks, and whereas the Nifty is of 50 stocks from different sectors. So here the option buyer, call option buyer will be called as CE, call European, and PE is put European. So for the put option we will write PE. This is the expiry date. Bank Nifty and Nifty is available in weekly. So there will be a weekly expiry on the last Thursday. And as you can see, 5th November, this is the expiry date, and I am recording this video on the 5th November only. You will find the strike price of all the expiring index options will have the same price, and their LTP, their premium will become 0 on this day. What is a strike price? It is a fixed price at which the asset can be a index, Nifty or Bank Nifty. It can be a stock like Reliance, or it can be any currency. So option is a freedom which which the buyer receives. Option is the right or freedom to buy at a strike price. So you can get a right to buy, or you can get a right to sell that particular index as a asset. Now there are two traders in the market. One is the bullish trader and another is the bearish trader. Bullish trader says, I am anticipating a rise in the market. Nifty will go from 11,800 to 12,500. So I will buy a call option because I am bullish. Similarly, if I am bearish, I will sell the call option. I think the market will fall and I will sell the call. Next, again a bullish trader can sell the put option if he feels that market will increase from 11,800, Nifty will go to 12,500. And if I'm anticipating that market will fall, I will buy a put option. If I think Bank Nifty will go down because of US elections, if the Trump is not getting selected, the market will go down. So if I'm having a bearish outlook, I will buy a put option. What is call buyer and call seller? Buyer has a freedom. Freedom means right to buy. In call, you have to write right to buy. Freedom to buy. That means buyer has a choice to buy at a strike price or buy from the or leave at the strike price and lapse the call option. Call seller has no freedom. He sold his freedom by receiving the premium. So he lost his freedom by giving a chance to buyer and he is taking a premium from the buyer. So call seller will receive the premium from the call buyer. So he is selling the freedom option to the call buyer. Put buyer and put seller. Put buyer has a freedom, that is right to sell but no obligation to sell at a given strike price. Put seller has made a contract. So he sold his freedom, that is the choice, to the buyer and he is bound to buy at a particular strike price. So here the put seller is the buyer at a particular strike price with a commitment because he received the premium. So he has a commitment, seller has a commitment to buy from the buyer because put buyer is the seller of the option. From this loss of freedom, he is bearing the risk. Seller charges premium. So put seller will receive premium from put buyer. What is a premium? Premium is a price at which freedom or option is sold by the option seller. Option seller is taking high risk. Because of the time decay, he will charge a premium. So this is one type of betting. For this betting, the option buyer is getting a choice to book a profit but to limit a loss. So here the loss of freedom of the put seller is bearing risk and the seller charges the premium. In both the cases of call and put, you will find the seller is charging premium to the buyer because he loses the freedom to exercise or not to exercise the call and put option. When you buy a put option, you buy a freedom, you buy a choice. So for that you have to pay some compensation, that is premium. So buyer pays the premium, seller sells the option and the freedom, so seller receives the premium. Why is option seller taking risk? Now they are very smart investors, they have a calculation in their mind and they know the direction of the market. They are very sure about the market. Think about the banks, think about the mutual fund companies, think about the insurance companies. They have already lot of market intelligence, they have statistics, they have insider news and they are in the market from very long. So because of past experience, of course they will be winning. So they charge a he is charging premium to cover any kind of risk. So they receive the premium from the market as a seller. So basically seller is very intelligent person or intelligent entity which is taking risk but receiving premium in advance. What is a long call? Long call means buying the call. You anticipate the price will increase. Long call is having bullish view, unlimited profit. Spot price is greater than strike price. At, at expiry day, if the spot price is greater than strike price, you will exercise the call. As a buyer of the option, you want to make a profit. So that is in the money. So you will exercise the call and you will book your profit. And seller will give you that profit. Okay. Buyer will receive the profit from the seller. When the spot price is less than the strike price, buyer will not exercise the call because he is not getting profit out of it. When the spot price is equal to strike price, it is in at the money option. At the money, and you will not exercise the call because you will not get profit from this situation. So if I lapse the option in two cases, in the above two cases, if I lapse the call, that means not exercising the call, maximum loss will be my premium paid. What is short call? Short call means selling the call option. You anticipate that the price of market or the stock or the currency will fall. That time you will take a selling of call option because you have a bearish view. So your profit is limited to premium which you will receive upfront, that is in advance, and the loss is unlimited when the market is going reverse. You have anticipated the market will decrease, but it goes reverse, the market is increasing, so you will get a loss unlimited. At that time, buyer will exercise the call when the market is going up and you will have unlimited loss. Long put. Long put means buying the put option, anticipating that in future the price will fall. So long put trader is having a bearish view. Now how to earn an unlimited profit? By buying a put. By buying a put at a strike price, whenever the spot price at expiry or before expiry it is less, when the spot price is less than the strike price, this is the time to exercise the put option because you will get the profit, that is in the money. When the spot price is more than strike price, the buyer will say, why I want to book my loss? I have an option. So he will not exercise the put because it is out of money. When spot price is equal to strike price, again he will not exercise the put because it is at the money. So in the above two cases, there is a maximum loss to the buyer is the premium paid because the buyer so maximum loss will be the premium paid because you are lapsing the put option in the above two cases, so you will get a maximum loss of premium paid. What is short put? Short put is selling the put option. You feel the price will increase, you anticipate the market will rise, so short put is having a bullish view. This is the limited profit up to premium, and the loss is unlimited when the market is decreasing, going reverse. That time those traders who have taken a long put, they will exercise the put option, and in that way the put option seller will have an unlimited loss, and the profit is limited to premium because this premium is because you are getting a obligation, you have a commitment, so you are receiving the premium in advance. Thank you very much. I hope you like the video. Please like and subscribe my channel.